us look into returns and risk as a chapter now. So we have two ways to look into the risk and return. One is realized and the other one is expected. What is already the stock has given, realized in the last couple of years, and what is my expectation from this? Realized returns and risk, expected returns and risk. Okay. So when I say returns from the stock, it can be two things. One is it gives me a dividend. Right? When I buy a share, it gives me a dividend, and that is called as yield. So it can be either zero, that is company doesn't pay any dividends, or it will give some dividends, so it is plus. Whereas the other component of returns is change in price. People always want to sell share at higher price and want to make profits, right? So that can turn to be 0, plus or even minus, right? So there are two components of returns. As I said, one is dividends, the other one is capital gain. Right? So dividends comes under income from other sources. Capital gain has a separate head of income called as capital gains. Right? Dividends is exempted from tax. Companies pay dividends on behalf of shareholders. So shareholders need not pay any dividend tax. It is exempted from tax. Whatever dividends you get from shares, it is all exempt. Whereas capital gain, it depends on whether it is a short-term capital gain or a long-term capital gain. That is, if you hold a share for more than a year, or if you hold a share for less than a year. If you hold a share for less than a year, it is called as short-term capital gain. If you hold for more than a year, it is called as a long-term capital gain. Okay. For fixed assets, it is 3 years. For land, building and other things, if you hold for 3 years and above, it is long-term capital gain. If it is less than 3 years, it is short-term. Whereas for shares, 1 year. Okay. Financial assets. So did you understand this component? Yield can be 0 or plus, whereas change in price can be 0, plus or minus. I bought at 100 rupees and now it is trading at 80 rupees. So my returns can be even negative here. Okay. So that is returns. What is risk? Risk refers to the possibility that the actual outcome of an investment will differ from its expected outcome. When people say don't take risk, right? Why they say don't take risk? Because my expectation would be different from actual happening. Right? So what is risk? Risk refers to the possibility that the actual outcome of an investment will differ from its expected outcome, not promised outcome. No one has promised anything here. My expectation is different, your expectation is different, but if that doesn't happen, I'll call that portion as risk. So what is risk in other line? Risk is the potential for variability of returns, change in returns, variation in the returns. Why that variation in returns happens? Because of existence of volatility in the markets. Volatility will be there in the market. Volatility is the inherent part of the market, which is always there. Because of that, my expected event or incident will change. That is called as risk. So what does risk suggest? Risk suggests that a decision maker knows the possible consequence of a decision and their related likelihoods. What does it mean? Understand this point very carefully. Here then the importance of statistics comes. What is the possibility then next year there will be a boom in the market? What is the possibility the markets will continue as it is, that is neutral in the market? Or what is the possibility that the markets turns to be recession? Right? I assume there is a 30% probability that the markets will be in boom probability. And I don't think it will reach recession. So I give 10% probability to it. And 60% I will say market will continue as it is. Right? So if markets turns to be in a boom market, I will get 22% returns. In normal market, I get 18% returns. In recession, I might get minus 15% returns. Okay. Now you read that statement. Risk suggests that a decision maker knows the possible consequences of a decision. What are the possible consequences? There can be a boom, there can be a neutral, there can be a recession. These are the possible consequences and their related likelihoods. Likelihoods means what? Possibilities. What is the probability it will rain today? 60% probability it might rain today. 40% it might not rain today. 60 plus 40 equals to 100%. So always this likelihood should match up to 100%. Probabilities should sum it up to 100%. Because any possible scenarios you take, all together should lead to 100%. Right? What is the probability India will win this match? What is the probability India will win the tournament? Right? Will not win the tournament. What is the probability Sachin will score 100 today, not score 100 today? All are likelihoods and possible consequences. So what they are suggesting is, each of the time know your possibilities and its outcome. Right? Last line is very important. In uncertainty, likelihood of possible outcome is not known. So people use two words. I am uncertain. I am uncertain means what? I am not in a position to give any probabilities to an event. Will it rain today? I am uncertain about it. That means I don't know. I am not in a position to assign any probabilities to it. So what we are trying to say is, we are living in a risky world. We are not living in an uncertain world. We are living in a risky world. Why? Every time we are trying to assign a probability to it. I don't know whether I had mentioned about this book name called as Against the Gods. Yes. Right? So there you can see who came up with this probability concept. Where are we today? Without the probability, are we stepping one step also ahead of where we are? Right? Or not? Right? In 16th century they came up with this probability concept, and today almost every theory uses this concept of probability. Whether it will rain today or not, whether tsunami will happen or not, whether India will win or not, whether this rocket will be successful or not, will the government come in Bihar or not, whether the stock gives this return or not, every simple thing is dependent on concept of probability, which came up in 16th century. So, measuring that uncertainty converts uncertain world into risky world. So if you look at casinos, if you look at gambling, they are all uncertain ones. Whereas stock market is a risky one. We are trying to measure that uncertainty. That is the difference between horse race and stock market. Here there is some knowledge which is going behind. Right? So don't always compare even stock market with something else like that. If you obviously do not spend any knowledge on that, even that turns to be. Right? You just listen to your friends' words or look at some CNBC TV 18 suggestion given by some person, obviously can lead to gambling only. Like how we learned the types of returns, right? We learned types of returns, right? Yield and change in price, components of returns. In the same way, we have to learn types of risk. What are the types of risks? I'll pass on this PPTs. Risk is classified into two main parts, systematic and unsystematic risk. The names might be different, but the classification is almost same in the organization also. At the top level, a CEO of the company should be well aware of the risk taken by the company what types of risk can be classified as systematic and what types of risk can be classified as unsystematic, a person should be knowing. Nowadays there is a chief risk officer also, right? CROs are there in the companies, right? So just look at the examples and tell me whether you can somewhat tell me the difference between systematic and unsystematic risk.
Okay, systematic risk is what you can predict, what you can speculate about.
Which one?
What systematic risk. You can predict, you can study on it, you can prove why it will go down, why it will go up.
Okay.
Systematic risk involves knowledge, previous experience, knowledge and certain...
You are speaking from which angle? You are what? What are you when you classify the systematic and systematic risk?
Systematic risk, like it involves some considering some parameters, or say like in our case dependent and independent. So we have certain known dependent, so there is known independent factors, and we can take that into consideration and we can calculate those things. But in unsystematic, there are unknown factors also which may impact these.
Okay, now let me make it very clear.
This unsystematic.
Are you discussing as an investor or are you discussing as a company?
As a company.
As a company.
See,
you are a company. Okay.
Unsystematic is more under your control, looks like. And this is more in the the outside extrinsic factors. More of these are.
Excellent, excellent. Just think again, so guys, what he said.
Okay.
What you might think. That's why I'm asking you whether you are thinking from an investment perspective or you thinking as a company. Let us first decide this. Think that you are a company.
Okay. So from company point of view, unsystematic is like what I can predict, what I can do from my end, what the company can do.
See, I should be knowing what is my business risk, right?
Ah.
As a Reliance Industries,
Yes.
I should be knowing what is the risk I'm taking in oil exploration business or whatever manufacturing sector, or cement industry should be knowing what is the risk involved in cement industry.
Yes.
Banking industry should be knowing what is the risk involved in the banking industry. Business risk means what? Changeover in the trends in the business, new product coming up, competitors launching their product, price change happening, new technology coming up. Right? Those are all which they have to be ready. Right? They are called as business risk.
And that is unsystematic.
Right?
Okay.
Business risk is the core business risk of the company. Strategies, tactics.
It's more unlikely unknown.
Yeah.
Side is unknown.
It is
You cannot
unsystematic.
predict all this.
Is it? Then how do you run the business?
Business, let us say like I run a computer company today.
Okay.
But, the current technology, everything changed to digital, mobile.
You have to switch over to that immediately.
Yeah, but it is like not always you can predict. I mean, it's not under my control. I mean, I may not be seeing 5 years ahead what will happen.
Is interest rate is under your control?
At least I can. It may go fluctuate to 5 to 7 or something. If I'm paying 5% interest, it may go up to 7. So a little bit known thing.
No, at least, but in this is
okay.
at least in
Beyond
this.
100%.
No,
See,
in this
if you look at a camera manufacturing company, obviously the oldest camera to the new camera technology have changed, and they have to immediately get into the new technology and other things. They have to get into it. Otherwise, they will run out of the business. Very simple. They will not be there in the business at all. So, business risk is something which each business face its own risk. Let me put it this way. Okay. And it differs from one company to another company. It is not common. Let me take an example like this. Infosys, it's a pure IT company. It was Reliance, which is very manufacturing company. Right? Oil. What is the main risk of Infosys is technology company, and their main revenue comes from outside India. 70% of their income comes from European and Japanese and American. They receive something in dollars, euros and yens. But being an Indian company, they prepare their balance sheet in rupees. You might have read yesterday's newspaper. Every company is crying that, Wipro has said, we are losing out money unnecessarily in translating currencies. Sometimes gain, sometimes loss. Yes, definitely. Risk is important. That gains and losses, if it keeps varying, that is called as risk. Variation in returns is called as risk. So because they receive dollars, immediately they have to convert into rupees and show. They receive pounds, they have to show in rupees. They receive yens, they have to show in rupees. So there is a translation process here, and every time they translate, sometimes they may gain, sometimes they may lose. Continuously, if the prices are falling and falling, they might lose, right? Depreciation of currency is good for them actually. Depreciation of Indian currency is good for exporters. It is bad for importers, right? Now Reliance doesn't have this type of currency risk, forex risk. If we call it as what type of risk I am speaking of? Forex risk is not there for Reliance. But Reliance is mainly dependent on huge machineries which IT companies doesn't have it. And if any accident happens, you might have seen the fire breaking out in the middle of the refineries, or the entire ship catching a oil refinery ship catching a fire, you might have seen. It's a huge loss. Some Jamnagar factory catches some type of accident. It's common in manufacturing sector. Accidental damages is very common in manufacturing companies, which is not common for IT companies. IT companies have a very unique risk, that is forex risk, which is not seen for Reliance Industries. Right? So both of them should be very clear about what types of risk they are facing. Pharmaceutical company have a very different type of risk. They spend thousands of crores on their R&D. If they come up with a breakthrough, next 10 years they can rule the market by preparing some type of drug. Dr. Reddy's lab, Ranbaxy or Peramal, whatever it is, they are all sustaining because of what? Some breakthrough, some formula, this is malaria. Some recently, for worldwide first time in Europe, they have come up with some type of medicine which has not yet become commercial. In the next few days, it is going to become commercial. Right? So they will rule the market. Right? Some type of ointment, everyone will suggest Dr. Reddy's ointment, so then they are going to. If not, what happens? That entire research expenses is considered as sunk cost, dead cost, gone. That risk they should be knowing. Right? This is from the company's angle. What is financial risk? Their debt equity ratio. They should be knowing. How much more debt they have borrowed. They had borrowed 10 years back, and today time has come for them to repay their loan. They were not ready for it. They were not ready to repay the loan. They never thought 10 years will get over so fast. Now what will they do? They have to sell some assets or borrow some more money in order to repay this. It sends a wrong signal to the market, so that is financial risk. Credit risk. Maintaining the credibility is very important. Right? AAA rated or AA rated, that is all. So what we are trying to say is, we have to identify clearly what are the risks here, each company. From investor's point of view, I will discuss now. All this time we discussed from the company's angle. From investor's angle, it is much more simpler. What is that? Let me say I invest 100% of my money in Infosys. What happens is, if Infosys stocks doesn't do well, it's as good as my money is also not doing well, because all of my money I have invested in Infosys. 100% of my money I have invested in Infosys, so I am directly exposed to forex risk. I am not into forex business, but my investment is in company which is exposed to forex risk, so I am also exposed to forex risk. Or I will take 100% of my money and invest 100% of my money in Reliance Industry. I am 100% exposed to the damages which Reliance faces. Okay? But 50% of my money I will invest in Infosys, 50% of my money I invest in Reliance. Now what happens? If forex risk happens, only my 50% of my money is exposed to that risk, another 50% of my money is safe. If some damages happens, 50% of my money is exposed, another 50% is safe. What is the probability of rupee crashing and damages happening in Jamnagar factory? It is very less. Probability of A into probability of B equals to probability of AB. Joint probability. Have you not learned this? Right? So, probability of A. What is the probability that the rupee might crash? 30%. What is the probability that there is an accident in Jamnagar factory? 30%. What is the probability of both happening together? 9%. By investing 50% in Infosys, 50% in Reliance, what I am doing?
Risk, reducing the risk, overall risk.
So what is this process called as?
Portfolio.
Diversification. Right? Very simple, right? I am diversifying my risk. Think about 4 other companies which is not similar to Infosys and Reliance. I am much more diversified.
Tata's, Wipros.
Now, let me say, I invest 50% of my money in Infosys and 50% of my money in Wipro. Is it diversification?
No.
Why?
Industry.
So, diversification just doesn't mean investing in different companies. Diversification means what? Investing in those companies which do not have correlation. So here you know where statistics again comes. This is one subject which we cannot ignore, right? Speak anything, the statistics will come, I am here. That is the problem with statistics, right? You cannot ignore statistics when you learn any subjects. It will be there everywhere. I am here, I am here. So when there is a negative correlation, right, it is better to invest in those stocks. Don't buy 2 stocks which have a positive correlation because you are owning the same stock. Names are different, but you are buying actually risky same stock, same risky stock. Right? Either both will go up or both will come down. Right? Are you getting this? So first mantra in investment is what? Buy a stock which has a negative correlation. How to know whether 2 stocks have a negative correlation? Very simple thing you have to do is take last 12 months returns of a company X, take last 12 months returns of company Y, and a correlation. You know how to calculate returns? P1 minus P0 by P0. Take today's price minus 1 month back price divided by 1 month back price. Like that 12 months calculation you do, keep it in one column. 1, 2, 3, 12. Run a correlation, that should be negative. Then it is a good stock to buy. Already if you have one stock in hand, what should be the other stock you have to buy? That stock which has a negative correlation with this stock. By that way, doing this way, what is happening is, there is a business risk involved in Infosys, there is a financial risk, there is a credit risk involved in Infosys. I am not saying that is gone. At least from investor's perspective, that is gone. Infosys still have that risk. Infosys cannot throw that risk because if they throw their main risk, then why are they getting returns? Why is Infosys earning so much? Because they are taking that risk, business risk which other competitors are not taking. How Infosys returns are driven? Infosys returns are driven by their risks. They have to take the risk. But as an investor, I am not ready to take the risk. Investor has an option of diversification. Now let us come to these 3 risks. Market risk. What do you mean by market risk? Sensex falling by 1000 points. Suddenly, tomorrow morning, it will fall 1000 points.
no stock can go up. It's like swimming against the tide. Though your stock is a genuine stock, you are doing well, because market falls, you are a part of that family, 30 stocks, Sensex, you have to fall. Because there is a momentum. People are not looking at the company, some news has gone, which has become viral, right? People start selling it, right? So two things rules the market. One is fear, one is greed. Right? Out of fear, panic, people start selling it. Lehman Brothers stocks were trading $80-90. Yesterday evening, today started selling at 50-60 cents. Why? People didn't want to keep it. They started selling out of panic by news. Just by listening to news, they will sell it because they are at that point of time driven by fear. Market will keep going up. People will think today it will fall, tomorrow it will fall, it will keep going up. The market is ruled by greed at that time. I don't want to sell. I want to make more returns. I'm already sitting on 15% returns. I want 18% returns. I want 20% returns. I'm not ready to sell. Right? So greed and fear are two things which rules the market. Now, if Sensex falls, Nifty falls, every stock is bound to fall at that point. That is called as market risk. You read mutual funds last start. Mutual funds and investments are subjected to market risk. Right? What do they say? Mutual funds investments are subjected to market risk. So what is that market risk they are referring to? Systematic risk they are referring to. Why they are saying that? They say that we have done enough research on the markets, companies which we are investing. But if market falls, even our portfolio cannot stand, it will fall. So don't blame us. Mutual fund investments are subjected to market risk because it is a systematic risk. What does it mean by systematic risk? Like how I diversified Infosys to Wipro to Reliance, I cannot do it here. Because whether it is Infosys or whether it is Wipro or whether it is Reliance, if Sensex falls, even that stock will have to fall. There is no exception. Hence it is called as systematic risk. That means that risk is systematically present in all the stocks, whereas the unsystematic risk means which is not systematic. The risk which is there in Infosys is not there in Reliance. That risk which is there in Reliance is not there in State Bank of India. Unsystematic. Are you getting this? So unsystematic risk can also be called as what? Idiosyncratic risk. Company specific risk. Company specific risk is unsystematic risk, which company cannot do anything with it, whereas as an investor I can diversify it. I can reduce it. As an investor, I can reduce which type of risk? Unsystematic. As an investor, can I reduce systematic risk? No. Why? Because that is systematic across the industries, across the companies. If RBI cuts the rate by 1% or increases the rate by 1% interest, it affects all the companies. I cannot say I am investing in Infosys, it is not affected by interest rates in the market. It can't happen like that. Clear? So hence it is called as what? Systematic risk. Purchasing power risk means what? Another name for? Purchasing power risk is another name for what? Inflation. What do you mean by inflation? Purchasing power of money is called as inflation. What is the definition of inflation? Purchasing power of money. If inflation has come down, purchasing power of money has gone up. If inflation has gone up, purchasing power of money has come down. So now, let us quickly take an example. We will divide risk into systematic and unsystematic, right? In the calculations, we will see all those exercises in mathematics. Go to an Excel sheet. How do we go to an Excel sheet? Okay. I will recommend you to maintain in decimals. Okay, for what is it as calculated. So 0.18 means 18%. Okay. So instead of keeping it in percentage, 18%, let us keep it in decimals. Okay. So 18%, 22%, 25%, 15%. So how I would have calculated this 18%, 22% and all? It's a price change, right? 2009 December versus 2008 December. What is the difference? Like, okay. Now simultaneously, let's say we have a market returns also with us. Over. So we have to calculate risk and return. Okay. So the problem is calculate risk and return and split the risk into systematic and unsystematic risk. Here is the problem. With this details, what we have to do is what is the returns, what is the risk we are taking by investing in stock X. Okay. Also, how much portion is systematic and how much portion is unsystematic risk of this stock. Okay, clear with this question? No? Okay. So when I say returns, with this information, very simple thing I do is I calculate the average. Historical returns, this is called as. Over the period of time, it has given this much of returns, right? So equals to average of C3 to C9. Done? So what is this? I will keep it at 2 decimal points, just not to confuse, right? So stock X gave 11% returns on an average in the last 7 years, right? It's not in 7 years it has given 11%, it is 11% per annum average. Okay, that is how it should be understood. Okay, that is almost every year it has given you 11% returns. The upside like 25% and the downside like minus 15% is smoothed with the number 11%. Okay, in the same way market has given 12% returns. Okay, so this is the first answer. So returns is 11% and 12%. Now risk means what? Whenever I say risk, I am referring to standard deviation, variance and standard deviation. That is the by default proxy across. What do you mean the risk? The variation itself is risk. That's what we learnt in the definition, right? The potential variation in the returns is what? Risk. So I have to calculate variance. You know how to calculate variance? We have done enough problems. So what do we do? Every time I subtract this with the average, then I take square, then take the average. You all remember? Let me show it. Right? So let us solve this problem overall, so it will be a revision for you. Okay? It will be a revision, completely a revision for you. So deviation of X and deviation of market. How do I calculate deviation of X? It is stock X minus return. So every time what I have to do? I have to keep subtracting with that 11%. So what will I do? I will lock that cell C10. Right? When I lock C10, what I will do is when I move to the right side, I want C10 to become D10. Correct? If I lock, let's say I press F4. F4 button, what will it do? It will lock the cells. Now what is locked? C is also locked, 10 is also locked. Correct? The problem with this is what? If I scroll down, it works fine. Now you see, click F2 for editing mode, you can see 25% minus 11%, that is correct. But if I scroll it to the right, I want deviation of markets also. Still it will take this 11%. So I don't want that. So what I will do, while locking this C10, I will click once again F4. Now what happens? C is unlocked, only 10 is locked. Click again F4, C is locked, 10 is unlocked. Click again F4, both are unlocked. Now went back to the normal situation. Okay, this F4 button is used for locking, very simple locking. So once I press F4, both C and 10 are locked. But I don't want C to be locked. I want only 10 to be locked. So I will keep it at this level. Okay. So now what I will do? I will scroll it to the right. I will scroll it down. Now you can see any time these numbers will be perfect. 70 minus 12. Correct? Yeah. Got it? Now what I do? Deviation of X square. In the same way, deviation of market square. You know why do we do deviation? To remove these negative numbers. We have discussed this. If you look at this numbers, I will select this deviation of X. Just look at this. Average is how much? 0. Sum is how much? 0. That means these numbers are literally useless for me. So I will square it. See, I have discussed all these things in my statistics class, right? So let us not lose time on that. So E3 into E3. In the same way, F3 to F3. Okay. Now what do we do? Take average, right? Of this. What is this average called as? Variance. Then what do I do? Square root. Square root of variance is called as
Standard deviation.
standard deviation. So 14%, 12%. So this is variance. This is standard deviation. Variance cannot be interpreted.
Still it does a name, square. So if I square, doesn't mean anything, but still it does a
It's very difficult to interpret. 0.02 square is the standard deviation. I mean, like, is the variance in the returns. Okay, any question till now? So, if someone asks you, what is the returns and risk of stock X? 11% returns with risk of 14%. What does it mean? Standard deviation means it can be on both the sides, positive and negative. So it can be 11% plus 14%, or it can be 11% minus 14%. So you can expect something like this in future, right? Minus 4 to 25% you can get any returns from this stock, because the deviation is like that. There is a huge fluctuation. See, sometimes there is a positive return, sometimes there is a negative returns. There is a fluctuation. So more the fluctuation, more will be the standard deviation. More the standard deviation, more will be your range like this, right? So some stocks will be like minus 40% to plus 40%. Huge standard deviation. What will be? Okay.
So if that value is huge, say like minus 40 to plus 40, so better not to invest in that.
No, I expect more returns. See, more the risk, more the returns. Very simple. Business. If you want to get rid of risk, obviously one thing you can do is place the money in fixed deposit. If I want to take risk, who you are? Are you a pensioned person or a salaried person? What age you are? Obviously, I cannot play with the pension money. Your answer, your question is correct. When you invest in the market, right, your age and what type of income you are placing in the market all matters. If I am ready to take risk, I am okay with that, then okay, place it.
This data is small, so it's easy to look at. Can I take the min max and tell?
No. I have told you what we have to do in my statistics class. You remember we had drawn histogram and all those things? That you have to do.
Because it's a smaller data, so I can easily see, okay, it's minus 4, the percentage is
Exactly.
minus
So
4.
what I strongly suggest is take last 3 years at least daily data. Daily data. Calculate daily returns and daily standard deviation. Convert that into annualized returns and annual standard deviation. How do I convert daily returns into annual returns?
Sorry?
This is 11% is the annual returns. Let's say my data is a daily returns. That means average is also daily average, right? How do I convert into annualized number? Multiplied by 250. I told you there will be 250 trading days in a year. So daily returns will be multiplied by 250. In the same way, standard deviation will also be daily standard deviation in that case. How do I convert into annualized standard deviation? Multiply with square root of 250. Keep this in mind. Write down somewhere, otherwise you will forget. So daily returns into 250 will give me annual returns. Daily standard deviation into square root of 250 will give me annual standard deviation. So what I am suggesting you today is, before coming to the next class, take up any one stock from either Sensex or Nifty, popular stock, right? Manufacturing company or cement company preferably, not IT companies, right? Take up some company, take last 3 years daily prices. Simultaneously, take last 3 years Sensex or Nifty index closings. Draw the histogram like how we did in our statistics class. First calculate returns, daily returns, then put the histogram, then calculate what is the average and standard deviation. Okay.
So that is annual.
Annual returns.
Standard deviation. Annual daily standard deviation into square root of 250 is annual standard deviation. Daily returns into 250 is annual returns. Okay. Now how do I calculate covariance? Covariance is product of deviations, right? So what do I do? Deviation of x into